Here's a summary of PayPal's Q4 2025 earnings call, suitable for reading aloud. Good morning, everyone. Today, we're reviewing PayPal's performance for the fourth quarter and full year 2025. Key financial metrics and performance highlights. PayPal reported solid performance across multiple areas in 2025, driven by strong growth in Venmo, which saw revenue increase by approximately 20% to $1.7 billion, excluding interest income, and surpassed 100 million active accounts. The enterprise payments business also showed a significant turnaround, delivering 7 consecutive quarters of profitable growth and returning to double-digit volume growth in Q4. Together, these businesses contributed nearly half of PayPal's 6% transaction margin dollar growth in 2025. By now, Pay Later, BNPL, continued its strong trajectory, exceeding $40 billion in TPV for the year, a growth of over 20% year-over-year. However, the company acknowledged underperformance primarily within branded checkout, which experienced a deceleration in TPV growth to 1% on a currency-neutral basis in Q4, down from 5% in Q3. This slowdown was attributed to 3 main areas. 1. U.S. retail weakness, particularly affecting lower and middle-income consumers. 2. International headwinds, notably in Germany, due to macroeconomic softness and increased competition. 3. Deceleration in high-growth verticals like travel, ticketing, crypto, and gaming. Management's forecasts for future quarters and 2026 guidance. For 2026, PayPal anticipates that targeted growth investments will represent approximately 3 percentage points of headwind to TPV dollar growth, while aiming to drive long-term benefits. These investments are heavily focused on branded checkout and BNPL. Q1 2026. The company expects low single-digit revenue growth on a currency-neutral basis, with TPV declining slightly or remaining roughly flat. Non-transaction operating expenses are projected to grow mid-single digits, and non-GAAP EPS is expected to be down mid-single digits. Full year 2026. TPV is forecast to decline slightly or remain roughly flat, excluding interest and customer balances. Non-transaction operating expenses are expected to increase by approximately 3%, and non-GAAP EPS is projected to range from down low single digits to slightly positive. The company anticipates at least $6 billion in adjusted free cash flow and approximately $6 billion in share repurchases. Branded checkout outlook. For branded checkout specifically in 2026, guidance is for slightly positive to low single-digit growth, with indications that the early part of the year is trending slightly better than Q4. Significant risk factors. Execution on branded checkout. The primary risk identified is the slower than anticipated merchant adoption and customer engagement for the redesigned branded checkout experience. Macroeconomic conditions. Continued weakness in U.S. retail and international markets poses a risk. Competitive intensity. Increased competition across payment methods and platforms remains a concern. Merchant prioritization. Merchants have competing priorities, making integration and adoption more complex than initially expected. Key leadership statements. Jamie Iannone, outgoing CEO. Jamie acknowledged that PayPal's execution has not been fast or focused enough, and that the company is taking immediate steps to address this. He highlighted Venmo and enterprise payments as areas performing well, but admitted they were too optimistic about the speed of change and customer adoption in online branded checkout. He emphasized that the strategy for branded checkout now centers on 3 fundamentals: experience, presentment, and selection, with a renewed focus on high-impact merchants and integrating biometrics with new experiences. Jamie also stated that they are no longer committing to the specific 2027 outlook provided at Investor Day, given the more demanding environment and execution challenges, and will provide guidance 1 year at a time. Steve Winokur, CFO. Steve provided detailed financial figures, noting that non-GAAP EPS came in slightly below guidance due to a higher-than-expected tax rate and lower-than-expected non-GAAP operating income. He highlighted the diversification of revenue growth drivers such as credit, PSP profitability, and Venmo monetization as key to offsetting branded checkout headwinds. Regarding 2026 guidance, he emphasized that the projected headwinds are due to targeted growth investments aimed at long-term benefits, with about two-thirds allocated to branded checkout and BNPL. He clarified that the investments have already started and will impact results throughout the year, not just in the back half. Summary of key statements and takeaways. Leadership transition. The most significant announcement is the appointment of Enrique Lours as the new president and CEO, effective March 1 to accelerate execution and bring greater discipline. Jamie Yanone will serve as interim CEO during the transition. The board's decision is framed as being primarily driven by execution, not a change in strategy. Enrique Lours, with his extensive experience in driving disciplined execution and transformations, is seen as well-suited to address the current challenges. Branded checkout: the core challenge. The central theme of the call revolves around the underperformance of branded checkout. While the product has been reimagined, the pace of merchant adoption and consumer engagement has been slower than anticipated. The company is implementing a sharpened focus on improving the consumer and merchant experience, competitive presentment, including upstream BNPL messaging, and enhancing loyalty and selection. Refined go-to-market for branded checkout. PayPal is shifting its approach to focus on strategic, high-impact merchants rather than trying to optimize for every merchant simultaneously. They are also emphasizing the simultaneous deployment of new experiences and biometric enablement for a greater conversion lift. Diversified growth drivers. Despite branded checkout challenges, PayPal is seeing strong success in Venmo, enterprise payments, BNPL, and omnichannel initiatives. These areas are crucial for offsetting headwinds and contributing to overall growth and profitability. Revised outlook and financial discipline. Due to the execution challenges and a more demanding environment, PayPal is withdrawing its previous multi-year outlook and will provide guidance on a one-year basis. The company is committed to disciplined capital allocation, including share repurchases and dividends, while making strategic investments for long-term growth. Consumer engagement is key. A recurring message is the importance of driving deeper consumer engagement through initiatives like PayPal Plus and a revitalized app, which is seen as critical for driving repeat usage and influencing checkout preferences. Merchant engagement strategy. The company is tailoring its merchant engagement strategies, recognizing that different merchants have unique needs, and is now employing dedicated teams for high-impact merchants to drive adoption of new integrations, biometrics, and upstream presentment. In essence, PayPal is undergoing a strategic reset with new leadership to tackle execution challenges, particularly in its core branded checkout business, while leveraging its strengths in other diversified growth areas to drive sustainable, profitable growth.